Hello, this is Gary Schnitkey with a farmdoc insight on revenue protection, RP. Revenue protection is one of the crop insurance products that farmers can use. It happens to be the one with a guarantee increase. Other products that are available at the farm level, which means that they make payments based on farm yields or field yields, include RP with a harvest price exclusion, doesn't have that increase in it, and YP, yield protection. There's also a series of products that are available at the county level that mimic RP with harvest price exclusion, and YP. RP happens to be the most used crop insurance product in Illinois for corn, and in 2020, use of that on insured acres is 93%. So it includes the vast majority of acres in Illinois for corn. Similarly, it has the most acres in soybeans. For soybeans, 92% of the acres are insured with RP. In setting up how RP works, there are two important variables that need to be known. The first is the guarantee yield, and usually that is based on the actual production history, APH yield, which is a history of yields based on the last 10 years for which we have yields for that farm. So those are averaged. That gives us our APH yield. We have to have at least 4 of those yields in that history. Otherwise, we use transitional yields or T yields, which are specified for the county and are much lower usually than the yields that are actually received. That APH yield is often adjusted up for the trend-adjusted APH yield, and it adjusts the APH up by a trend, which for corn usually is about 2 bushels per year. So trend-adjusted APH yield is what most farmers use to insure their acres in Illinois. So if you know the trend-adjusted APH yield, you got the guarantee yield. Also important is the projected price. The projected price is the average of settlement prices during the month of February, December corn contract, November soybean contract, both on the Chicago Mercantile Exchange. Those are used to set our guarantees. The harvest price, which is based on the same contract but in October, will be used to set our revenue. An example of the guarantee, let's say we have a trend-adjusted APH yield of 220 bushels per acre. This is corn. Our projected price is $5.50, and we choose an 85% coverage level. We get a minimum guarantee of $1,029, and that's a trend-adjusted APH yield times projected price times coverage level. That guarantee can go up if the harvest price is above the projected price. When choosing this product, the people that are using the insurance make a choice of coverage level from 50 to 85% in 5% increments. We have the highest here. If we lower that, we get lower guarantees. At the same time, we lower the premium as well. You can see, and this is a 2022 example for Champaign County, as we lower the guarantee from 85%, 3103, to 80%, 1544 an acre, we lower the premium. So less protection results in lower farmer paid premium. Let's go through a couple of examples of payments. First, let's have the yield stay the same, 20 bushels per acre, but our harvest price, which again is the October price, of those settlement prices turns out to be $460. Our harvest revenue then is $1,012, which is below our guarantee of $1,029, so we get a payment of $17 per acre. On the other hand, let's say that the harvest, let's have yields go up and prices go down. So this is a case which often happens in the Midwest. We have higher yields but lower prices. 240 bushels is our actual yield. Again, that's based on the farm yield. 440 is the price. We get $1,056 of revenue. We do not get a payment because that's above the guarantee. A final example is a drought year, and typically in drought years we have lower yields but higher prices. Think 2012. We have a yield in this example of 160 bushels per acre, a drought-stricken yield, but the price goes up to $7. We have harvest revenue of $1,120, but our guarantee has gone up. Our guarantee is now based on our 220 bushel APH yield times the $7 harvest price rather than that $5.50 projected price times our coverage level, 85%. Guarantee is $13.09 and we would get a $189 payment. That harvest guarantee increase is very critical during drought years. And drought years like 2012, that guarantee increase will increase payments from crop insurance. There are two other payments that can happen with RP. The first is prevent plant payments. If we're prevented from planting, we will get a payment from RP, and there's also replant payments if we have to replant the crop. In selecting the coverage level, most farmers in northern and central Illinois picks a coverage level between 80 and 85%, and that's the same across Iowa, northern and central Illinois, and Indiana. Southern Illinois farmers typically pick between 70 and 80%, and a lot of the reason for that is because the premiums go up when you get outside of northern and central Illinois. Southern Illinois typically has more risk than northern Illinois, and they have higher premiums, and farmers in the past have sort of cut their premiums in the $15 to $20 per acre range. So most farmers pick premiums in that $20 an acre range, and keeping those coverage levels high provide good protection for a farm once the year growing or the projected prices have been set. This has been a FarmDoc Insight on RP crop insurance.